Silver, 2026. Why this metal stopped acting normal. Something changed in silver, and it wasn't subtle. Silver didn't just stop behaving like a sleepy commodity. It started trading like a strategic resource. Physical bids pushed above paper prices. East-west premiums exploded. The futures curve flipped into stress mode, the kind of structure you usually see when supply is under pressure, not when markets are calm. And if you think this was just a strange year-end distortion, stay with me. Because the signals we saw in late 2025 don't point backward. They point directly into a potentially explosive 2026. Hey everyone, John A.G. here. Today I want to break down 5 core reasons why silver may become one of the most important markets to watch in 2026, and why people who wait for perfect confirmation often end up buying after the easy money is already gone. We're going to talk supply. We're going to talk governments. We're going to talk futures market warning signs. We're going to talk central bank policy. And we're going to talk volatility, the kind that shakes people out right before the move they were waiting for. And at the end, I'll leave you with 2 real questions, because the comment section is where we compare notes in real time. Before we dive in, quick favor. If you appreciate straight, no-nonsense breakdowns like this, subscribe. 1 tap. That's it. Because 2026 is going to move fast, and you don't want to miss the weeks when silver starts signaling its next move. All right, let's get into it. 2025 wasn't hype, it was a result. When people look back on 2025, many will remember the headlines, but markets don't trade on vibes. They trade on outcomes. And the outcome for silver in 2025 was clear. It was one of the top performing assets of the year, up roughly 146%. Moves like that force an uncomfortable question. Was 2025 the blow-off top? Or was it simply the wake-up call? Because in metals, the biggest moves often come after the crowd notices, not before. What makes silver different from many hot trades is that it isn't just a story or a sentiment play. Silver is a bottleneck. It's used, consumed, and competed for. And once shortages start forming, price becomes secondary to access. That brings us to reason number 1, and this is the foundation of everything else. Reason number 1, a structural deficit that doesn't care about opinions. Structural deficit sounds like a clean term. The reality is messy. For roughly 5 consecutive years, silver demand has exceeded supply. Industrial use plus investment demand has been larger than what mines and recycling can deliver. So what fills the gap? Inventories. Above-ground stockpiles get drained. Institutional holdings get tapped. Metal that was never meant to be sold gets quietly mobilized to bridge the shortfall. But inventories aren't a solution. They're a buffer. And buffers shrink. Here's where the psychology changes. When inventories decline, remaining holders become reluctant sellers. They stop offering metal at yesterday's price. Scarcity alters behavior. In surplus markets, sellers chase buyers. In deficit markets, buyers chase sellers. And price becomes the question. What convinces you to give this up? That's why structural deficits tend to create a ratchet effect. Each wave of demand hits a higher wall. Silver has another complication. Much of its demand is non-negotiable. Electronics, solar, medical equipment, industrial processes. Factories don't pause because a chart looks extended. Manufacturers either secure supply or lose output, and lost output is often far more expensive than paying a premium. Deficits don't end because commentators want them to. They end when price becomes painful enough to destroy demand, or when new supply finally arrives, and supply takes time. We're going to talk central bank policy, and we're going to talk volatility, the kind that shakes people out right before the move they were waiting for. And at the end, I'll leave you with 2 real questions, because the comment section is where we compare notes in real time. Before we dive in, quick favor. If you appreciate straight, no-nonsense breakdowns like this, subscribe. 1 tap. That's it. Because 2026 is going to move fast, and you don't want to miss the weeks when silver starts signaling its next move. All right, let's get into it. This is where silver stops being just a commodity. In 2025, the United States officially designated silver as a critical mineral. That label isn't symbolic. Critical means essential to national interests. It means supply chains matter. It means resilience matters. And once a metal enters that framework, it stops being treated like a simple investment asset. Governments don't trade charts. They don't chase momentum. They accumulate for control. At the same time, signals emerge that Russia is allocating resources toward precious metals reserves that include silver. Whether it started as rumor or policy trial doesn't matter as much as the direction. Then there's China. Starting January 1st, China tightened controls on silver exports. That's not a casual adjustment. That's a strategic posture. Zoom out. The U.S. labels silver critical. Russia allocates reserve exposure. China restricts outbound flow. Different motivations. Same result. More competition for a metal already in deficit. That's how supply quietly disappears from global circulation. Reason number 3. The futures market started screaming. Most people ignore backwardation because it sounds technical, but the message is simple. Normally, futures prices rise the further out you go. Storage, insurance, financing. That's contango. Backwardation flips that structure. Near-term delivery costs more than future delivery. Translation: I want the metal now. In late 2025, silver entered deep backwardation. Near contracts traded dollars above later months, a structure typically associated with historical stress points. Why does this matter? Backwardation usually reflects one or more of the following: supply stress, surging physical demand, breakdown in settlement confidence. But the real impact is psychological. People stop thinking, I'll buy later. They start thinking, why are others paying extra to get it now? That question creates urgency, and urgency feeds itself. It's the same dynamic as a bank run. People don't run because they enjoy it. They run because they see others running. Industrial processes. Factories don't pause because a chart looks extended. Manufacturers either secure supply or lose output, and lost output is often far more expensive than paying a premium. Deficits don't end because commentators want them to. They end when price becomes painful enough to destroy demand, or when new supply finally arrives, and supply takes time. We're going to talk central bank policy, and we're going to talk volatility, the kind that shakes people out right before the move they were waiting for. And at the end, I'll leave you with 2 real questions, because the comment section is where we compare notes in real time. Before we dive in, quick favor. If you appreciate straight, no-nonsense breakdowns like this, subscribe. One tap. That's it. Because 2026 is going to move fast, and you don't want to miss the weeks when silver starts signaling its next move. All right, let's get into it. People love pointing to the 1980 nominal high as if it's a hard ceiling. But nominal prices ignore inflation. Adjusted for inflation, that old high sits far above what most people realize. Technicians who study multi-decade base formations argue silver has spent years building a foundation that could support much higher prices over time. That doesn't mean it happens in a straight line. It means the ceiling isn't as low as many assume. And in scarcity markets, price discovery isn't polite. In late 2025, the Federal Reserve announced it would halt balance sheet runoff starting December 1st. That matters. Runoff was part of tightening. Ending it is a directional pivot. It's not instant money printing, but it removes pressure. It shifts the stance. On top of that, policymakers have signaled rates are likely to move lower through 2026. Even if forecasts shift, the message is clear. The peak is behind us. Lower rates reduce the opportunity cost of holding metals. They compress real yields, and falling real yields historically favor scarce assets. Here's the bigger picture. With high debt levels and fragile systems, central banks usually choose stability over discipline. Something cracks, and liquidity returns. Silver, being a smaller market, tends to react faster and harder when that happens. Volatility isn't a bug in silver. It's the mechanism. It's how silver transfers metal from weak hands to strong hands. Late 2025 gave us a perfect example. The premium between Shanghai prices and Western venues like COMEX blew out, reaching levels rarely seen. Historically, arbitrage would close that gap quickly, but when spreads stay wide, it tells you something important. The pipes are clogged. Physical movement isn't frictionless. Metal matters more than paper reports emerged of buyers approaching producers and offering premiums far above spot. First $8 over, then $10 over. And who were the buyers? Manufacturers, who need silver to operate. Traders, who believe the market is mispriced. When necessity and speculation stack together, volatility expands. Even leveraged short silver ETFs experienced record inflows followed immediately by record outflows. That's not conviction. That's panic and forced repositioning. Which is why anyone watching silver in 2026 needs a plan that survives noise. Silver will rip. Silver will drop. Silver will do both when headlines are loudest. Here's the bigger picture. With high debt levels and fragile systems, central banks usually choose stability over discipline. Something cracks, and liquidity returns. Silver, being a smaller market, tends to react faster and harder when that happens. A year of performance forced attention. Multi-year supply deficits drained buffers. Governments are treating silver as strategic. Futures markets showed stress. Monetary policy removed headwinds. Physical dislocations exposed real scarcity. That's a dangerous mix for people waiting for perfect entries, because the best silver moves often come when buying feels uncomfortable. Silver doesn't climb smoothly. It climbs like a broken staircase. Climb, drop, climb, drop, then jump. That's why 2026 has viral potential. Shocking moves attract attention. Attention brings new buyers. New buyers tighten physical supply, and the loop feeds itself. First, what do you think becomes the dominant driver in 2026? Industrial demand or investment demand? Second, if the East-West premium stays wide, what breaks first? Confidence in paper pricing or the willingness of physical holders to sell? Drop your thoughts below. I read the comments, and they shape what we cover next. Final reminder, if you want to stay ahead of this story as it develops, subscribe. Because the biggest mistake in silver is showing up after the move, when risk is higher and upside is smaller. Take care of yourselves, take care of each other, and I'll see you in the next video. And remember, volatility is the price of admission of